Hello and welcome to The Deal. I'm Matt Miller, The Deal's editor-at-large. Today I'm talking to Jason Fox. Jason is Managing Director and Co-Head of Global Investments at W.P. Carey, Inc. Jason, thanks for dropping by.
You're welcome. Thanks for having me.
Thank you. Now, W.P. Carey just announced a $4 billion merger with your affiliate CPA 16 Global. I'd like to start by asking, how will this transaction impact your evolution from an investment manager into a global specialized REIT?
Right. Yeah. I mean, really, the goal of ours as a company is to continue to increase our assets under ownership, and this transaction is helping to do that. I think we're going to increase our equity market capitalization to $6.5 billion pro forma, and total assets under ownership to around $10 billion. So it accomplishes that goal, and really that's important for us for a couple of reasons. One is we want to continue to, in this evolution of shifting our revenues from less predictable structuring income to more stable and more predictable real estate rental income. So that helps. And certainly we want to add to our scale. By doing this in succession to our merger from last fall with CPA 15, we are adding scale. We're becoming one of the largest net lease REITs in the marketplace right now, and that's going to allow us to access different forms of capital on a go-forward basis, help us be more and more competitive on continuing our asset strategy, whether it's accessing the debt markets, equity markets, preferreds. It'll give us some options, and it'll be more efficient as we add scale. So that's the goal.
Great. Now, W.P. Carey has made, I think, 4 fairly sizable acquisitions in Europe this year. And what for you makes Europe attractive at a time when, frankly, most investors are running for the exits? Right.
Well, I think one of the things that makes W.P. Carey unique is the fact that we are a true global investor. We've started based in the United States, but currently we have around 12 investment professionals in the United States, in both New York and Dallas. But we also have 5 in Shanghai. We have 4 in London. We have a person on the ground in India, and as well as a person on the ground in Brazil. So this allows us to go to markets where we think the best risk-return opportunities are. They're not always in the United States, and right now, Europe, we're seeing, is a good investment environment for us. When there's distress, it creates opportunity, and some of the better deals that we have done in the United States were back in 2009, including purchasing the New York Times headquarters here in New York City. So we're seeing similar opportunities in Europe right now. And really our focus has been on the northern and somewhat eastern sections of Europe, the more stable countries. And those acquisitions that you mentioned in countries like the Netherlands, in Poland, and Finland are good examples of that. And these are long-term net leases. These are backed by good, strong, credit-worthy companies, including H&M, who's one of the largest clothing retailers in the world. A company called Royal Friesland Campina, which is the 4th largest dairy company in the world, and Tommy Hilfiger, which is the name I think everyone knows.
Now W.P. Carey specializes in net lease REITs, and as I understand it, these are properties you acquire and then lease back to a single tenant who manages the building. What is it about this asset class that you like as opposed to, say, your standard office or retail center acquisition?
Right. I think there's a number of things. I mean, the largest advantage of being a net lease investor is that you're buying stable, predictable cash flows. Unlike owning a multi-tenant office asset, there's lease rollover in the short term. There are expenses that the landlord needs to pay, such as leasing commissions on when new tenants come in, capital improvements, the roof, the HVAC system. Whereas a net lease investment, that really means that the landlord is very passive, and all the ownership responsibilities remain with the tenant. That includes maintaining and repairing the building, including capital replacements like roof and structure and systems. It also means that the tenant is responsible for paying insurance and taxes. So all this means is we're generating very predictable cash flows with low CapEx requirements, which is what our investors want. They want income-producing assets, and that's what we're doing. We're a dividend-paying company and have a very long track record of paying a long, steady dividend. And that's mostly because of the type of assets that we're buying.
Very good. Jason, thank you so much for coming by and talking, and thank you for watching. This is Matt Miller with The Deal.